The crisis did not begin in a bank. Its roots reached back to San Francisco. The April 1906 earthquake forced British insurers to pay out claims from home funds, draining gold from London equal to about 14% of England's gold money stock. The Bank of England raised its discount rate, and over the following months, European central banks together squeezed the American finance bills that had been funding U.S. trade. That tightening pulled gold and credit out of the United States and was a major factor pushing the country into recession by May 1907. Stocks had already slid about 8% in a quiet decline. The timber was dry. It did not take much of a match. To understand why a small fire could spread, you have to see the crack in the system. New York trust companies competed with banks but held only about 5% of deposits in cash reserves against 25% for national banks. They were not members of the New York Clearinghouse, so they had no access to its emergency loans. Worse, they were a key link in stock market funding. Trusts made uncollateralized daylight loans to brokers, who used the proceeds to buy securities that backed overnight call loans from banks. A run on the trusts would not just sink the trusts. It could short-circuit the entire stock market. On Monday, October 14, 1907, Otto Heinze began aggressively buying United Copper stock, betting that short sellers would be forced to buy back borrowed shares at inflated prices. The stock leapt from about $39 to $52 in a single day. On Tuesday the 15th, he called for the shorts to return their shares and the price briefly neared $60. But the corner failed because short sellers simply found shares elsewhere. On Wednesday, October 16th, United Copper collapsed toward $10 and Otto's brokerage, Gross and Kleberg, was forced to close. The failed corner exposed an intricate web of interlocking directorates tying the Heinze brothers and their associate, Charles W. Morse, across banks, brokerages, and trusts. On Thursday, October 17th, the New York Stock Exchange suspended Otto Heinze and Company, F. Augustus Heinze's State Savings Bank of Butte, Montana announced insolvency, and runs began on the Mercantile National Bank, where Augustus Heinze was president, and on Morse-linked banks. By Sunday, October 20th, the clearinghouse had forced Heinze and Morse out of banking and declared the member banks solvent. That firebreak held for the banks, but the contagion leapt the wall into the trusts that the clearinghouse did not protect. As word spread that Knickerbocker Trust President Charles T. Barney was a Morse associate, depositors began to run on one of the largest trusts in the country, a run variously dated to October 18th or October 21st. On Monday, October 21st, Barney was forced to resign, and the National Bank of Commerce announced it would no longer clear for Knickerbocker, cutting it off from the payment system. J.P. Morgan had banker Benjamin Strong examine the books, but Strong could not verify solvency in time, so Morgan declined to help. On Tuesday, October 22nd, depositors withdrew nearly $8 million in about 3 hours, roughly $276 million in today's money, and Knickerbocker suspended just after noon. That suspension turned a local scare into a national panic. Knickerbocker's fall shattered confidence in every remaining trust. The run hit the Trust Company of America, which paid out about $1.5 million on the 22nd, $13 million on the 23rd, and $8 to $9 million on the 24th. As the trust dumped assets in fire sales and cut their loans to brokers, the stock market's funding pipeline collapsed. The overnight call money rate exploded from 9.5% to 70%, then toward 100%, and at times there were no offers of credit at any price. This was the 1907 version of a Lehman moment. With no public lender of last resort, J.P. Morgan, age 70, became one. He summoned the leading bankers to his Madison Avenue library, had them open their books, and pressed them to commit. He convened George Baker of First National and James Stillman of National City, and after auditing the Trust Company of America's books declared, "This is the place to stop the trouble." He channeled about $3 million to keep that trust open, part of a broader campaign in which the trust presidents were pressed into roughly $8.25 million in support. On October 24th, when the exchange's president warned he would have to close early, Morgan assembled pledges of about $23.5 million from 14 bank presidents by 2:16 in the afternoon. Roughly $19 million was actually borrowed that day, and the cash reached the floor in time to finish trading. The rescue ran on whatever could be improvised. Treasury Secretary George Cortelyou deposited about $25 million of federal funds into New York banks on October 24th, part of roughly $37.6 million placed across late October, plus $36 million in small bills to meet the runs. John D. Rockefeller put about $10 million into the trust rescue and publicly pledged half his fortune to support American credit. Starting October 26, the clearinghouse issued loan certificates as emergency currency, more than $110 million in New York and nearly $500 million in substitutes nationwide, and restricted cash convertibility, creating a cash premium that pulled in foreign gold. The plumbing worked only because a handful of private men chose to make it work. Two final dominoes nearly fell. Around October 29th, Morgan arranged the purchase of about $30 million in New York City bonds to keep the city from default. Then in early November, the brokerage Moore and Schley faced collapse over loans backed by Tennessee coal, iron, and railroad stock. Morgan locked dozens of bankers in his library overnight until the trusts agreed to a $25 million rescue loan and arranged for U.S. Steel to absorb the coal company. President Theodore Roosevelt approved the antitrust waiver on November 4th, deciding, in his words, on the instant before the stock exchange opened. Confidence returned, but the cost was steep. The wreckage was severe. The New York Stock Exchange fell almost 50% from its 1906 peak, the Dow bottoming at 53 on November 15th. Industrial output fell about 17% and real GNP roughly 12% into 1908, with unemployment climbing from under 3% toward 8%. The recession ran from May 1907 to June 1908, a contraction surpassed in severity only by the Great Depression. Tellingly, only a handful of national banks failed. The damage was concentrated in the less regulated trusts. On November 14th, Charles Barney, the ousted Knickerbocker president, shot himself. The deepest lesson was structural. The panic had centered on the trusts, institutions outside the clearinghouse, the era's improvised lender of last resort. A nation could not keep betting its financial survival on the discretion of one private banker who happened to be willing and alive. The United States was the only major financial power without a central bank. That realization changed how even the bankers themselves viewed the question, and it set the reform machinery in motion. Congress acted first with the Aldrich-Vreeland Act of May 30th, 1908, which authorized emergency currency and created the 18-member National Monetary Commission, chaired by Senator Nelson Aldrich, to study banking abroad. The commission toured Europe and issued 30 reports between 1909 and 1912. Then in November 1910, 6 men, including Aldrich, Paul Warburg, Frank Vanderlip, Henry Davison, A. Piatt Andrew, and Arthur Shelton, met secretly at the Jekyll Island Club in Georgia, using only first names and posing as duck hunters, because they feared the public would reject a plan written by bankers. There they drafted the Aldrich Plan, the blueprint for a central bank. The banker crafted Aldrich Plan, with a board of 46 and only 6 government appointees, was attacked as a tool of the New York Money Trust, and the Pujo Committee hearings of 1912 to 1913 documented exactly the interlocking power that critics feared. After Woodrow Wilson and the Democrats swept 1912, Representative Carter Glass and Senator Robert Owen rewrote the plan into regional reserve banks topped by a public, presidentially appointed Federal Reserve Board. The House passed it 298 to 60 and the Senate 43 to 25. On December 23, 1913, Wilson signed the Federal Reserve Act, creating a system built to furnish an elastic currency and act as lender of last resort. The 12 reserve banks opened on November 16, 1914. The story did not end there, and that is the point. The new Fed faced its first great test against a wave of bank panics in 1930 and 1931, and it fell short, acting inconsistently across districts and, by the Federal Reserve's own later account, doing less than the old clearinghouses had in 1907. Economists Milton Friedman and Anna Schwartz argued that this failure to act as lender of last resort was a major factor that helped turn a recession into the Great Depression. That failure forced the next reform, the 1933 Banking Act, co-sponsored by the same Carter Glass, which created the FDIC. Since deposit insurance began on January 1, 1934, no depositor has lost a penny of insured funds in a bank failure, with coverage today of $250,000 per depositor, per bank, per ownership category. The practical takeaway from a 1907 panic. Within those limits, FDIC insurance means a bank failure can't wipe out an insured deposit the way it wiped out depositors who had no safety net at all.